Hi friends, welcome to my channel. Friends, the topic for today's discussion is national income aggregates. Here we will try to know what is national income and what are the different aggregates that are used to measure the national income of a nation. Friends, you know that whenever we want to know the economic performance of a country, the common parameters that we refer to is the gross domestic product or national income. So in this video, we will see how do we compute those and what are the difference between these. So first, as the name itself tells, it is national income. So what is a national income? So national income, as the word itself says, it's income. So how do a country generates income? A country generates income by the production of various goods and services. So when we sum together the various goods and services that are produced in a country, we get national income. So generally a national income is measured for 1 year. So maybe it's an accounting year. It is an accounting year which starts from 1st April to 31st March. So when I say national income, it is how much within this period of 1 year goods and services are produced. When we say goods and services, we are referring to the final goods and services that is in a finished form, and we are not talking about any intermediate goods and services. Also, one thing you have to remember that when we say national income, we are talking about the money value or the monetary value of all the final goods and services. Because in a country, there may be production of wheat, there may be production of cotton, there may be production of edible oil, there may be production of clothes. So these have different units of measurement. So in order to add them all, we need to convert them in monetary value or money value. So as you can see, the first point, it is the aggregate monetary of all final goods and services that are produced in a country during a year. The key points out of this is that it is expressed in monetary value and it relates to a particular accounting year. It includes all the final goods and services and it is a flow concept. Okay, so it's not a stock concept, it is a flow concept. We'll talk about it later. So far you remember that it is the money value of all the goods and services which are produced within an accounting year. Now national income as such can be calculated with some aggregates. The first aggregate that is used to calculate national income, we call it as GDP, which is the gross domestic product. Now, what is gross domestic product? Gross domestic product is same as what I said, that is the market value of all final goods and services that are produced within the domestic territory of a country during a year. Remember, when I say gross domestic product, we are referring to all the goods and services which are produced domestically within the national territory of a country. So within the national territory of a country, whatever goods and services are produced in an accounting year, we call it as gross domestic product. So the name domestic means within the domestic territory. One thing you have to note is that there may be some people who are Indian nationals and they might be earning something from foreign countries. Maybe person X has given some capital or invested some capital in some country, Germany, and has got some interest. So this interest income will not be added in GDP because it is not earned within the domestic territory of a country. So until and unless it is earned within the domestic territory of a country, we will not add it in GDP calculation. But if there is a person Y who belongs to Germany, but he has put some money in our companies or invested some capital in our country and he received some interest payment, that will be added in GDP because it is earned within the domestic territory of a country, of our country. So that is called GDP. So as you can see, it is a gross measure because it is a total measure. It is considering the monetary value or market value of current year's production of goods and services and within the domestic territory of a country. It includes income locally earned by non-nationals. So if there is any non-national who has locally earned some income, it includes that and excludes incomes received by the resident nationals abroad. That means the resident nationals, if they have earned something from abroad, that will be excluded. So what is GDP? GDP MP. MP means market price. If I have to convert all the goods and services in its market price, we call it a GDP at market price, which is C plus I plus G plus X minus M. What is C? C is consumer goods and services produced in a year. I means gross private domestic investment. G is the government's purchase or production of goods and services. X minus M. X is export, M is import. So we have to add the exports and minus the import. So export minus import is known as net exports. So we have to add this, and that gives you GDP at market price. So friends, GDP at market price means it takes into account the goods and services, the government gross private investment, the government purchase and production of goods and services, and net exports. If you have this information, you add them all, that will be your GDP at market price. Now we want to know what is gross national products, GNP. It is not GDP but GNP. What is N? N is national. That means it is not domestic but national. When I say national means it includes the income which is earned from abroad. That means it is not confined to only domestic territory. It also takes into account incomes which is received from other countries also. So you can see GNP is the money value of all final goods and services produced in the domestic territory of a country during a year plus net factor income from abroad. Now what does this mean? This means that if you have GDP, got gross domestic product, with this if you add net factor income from abroad, that becomes gross national product. You are no longer confining to domestic. Now you are taking income which is received from outside the domestic territory. So what you have to add? You have to add the net factor income from abroad, NFIA, net factor income from abroad. What does this mean? This means how much money we have received by delivering our factor services abroad. Suppose there are four factors of production: land, labor, capital, and enterprise. Land, the owner of land gets rent. Labor, one who gives labor gets wages. Capital, the one who provides capital receives interest. And enterprise, one who provides managerial service receives profit. These four factors of production, they receive their factor income. Now if I have delivered any factor service abroad, suppose maybe I have given some money or invested some capital abroad, so I get some payments like interest, that will be added. But there may be some people who must have got something from our country by delivering their factor service. Maybe there is a person who has invested in our country and received some factor service interest, that will be deducted. So how much we receive from foreign nation and how much we pay to foreign nationals, that is known as net factor income from abroad. So net factor income from abroad is the difference between income received from abroad for rendering factor services by the normal residents of the country to the rest of the world, and the income paid for the factor services rendered by non-residents in the domestic territory of a country. That means you have to move from domestic to national, you have to add net factor income from abroad. So GNP at market price means GDP at market price plus net factor income from abroad. So that means if you minus GNP and GDP, you will get net factor income from abroad. This makes the difference between domestic and national. So we know what is GDP at market price. We know what is GNP at market price. Move on. Let's talk about NDP at market price. We talked about GDP at market price. Now we are talking about NDP at market price. The difference between gross and net. Here we are talking about net. Means we have to minus something. Gross means total, net means after deducting something. What is the something? That something is known as depreciation. The another name of depreciation is capital consumption allowance. So as you can see here, when we have GDP at market price, if you minus depreciation, that is capital consumption allowance, we get NDP at market price. This is the net value. This is the gross value. Now what is depreciation? There are some capital assets which reduces its value due to passage of time. As time passes, its value reduces. Maybe because of wear and tear, we are using it repeatedly, so it reduces its value. Maybe it has become outdated or obsolete. So that's why there is a reduction in that value. That is called depreciation. So if you minus depreciation, you get converted into net from gross. Let's go to the next, that is net national product at market price. Here net means after depreciation, you understand, and national means you have to add the income from abroad. So if you have GDP at market price, suppose you have this value GDP at, suppose you have GNP at market price means gross national product at market price minus depreciation. Or if you have NDP at market price, you have to add net factor income from abroad. Suppose you have GDP at market price. From GDP at market price, if you have to reach to NNP at market price, first you have to convert gross to net. To convert gross to net, I have to minus depreciation. Then you have to convert domestic to national. For converting domestic to national, you have to add net factor income from abroad. So friends, when you have to know NNP at market price, you have to add factor income from abroad, net factor income from abroad, and you have to minus depreciation. You get net national product at market price. Let's move on. Now let's see that what is net national product at factor cost. All the time we were discussing was market price. Now we are talking about factor cost. Friends, it is quite logical that in an economy, if I have to know income, why not you add up everyone's income? That will give us national income, right? So everyone means what? So in an economy, there are four factors of production: land, labor, capital, and enterprise. If I add all their incomes, that becomes national income. For example, landlord will get rent, labor will get wages, capitalist will get interest, and enterprise will receive payment, profits. So when I add all these four factors of production's income, we get net national product at factor cost. So market price means I find out the goods and services, multiply with the market price, we get NNP at market price. But if I have to know factor cost, what I will do is that I will add all the incomes that is received by the factors of production like land, labor, capital, and enterprise. But suppose you are given NNP at, remember friends, NNP at factor cost is nothing but the national income of the country. So now suppose you are given NNP at market price. From market price, if you have to come to factor cost, what will you do? So remember that the difference between the two is that you have to minus indirect tax and subsidies. You add indirect tax and subsidies and minus it from here, you will get net national product at factor cost. So friends, if market price is there, if you have to find out factor cost minus the indirect tax and plus the subsidies, you will get NNP at factor cost. Right friends, so that's all for today. We have seen, and remember NNP at factor cost is also known as national income. So you have seen what is national income, its concept, and what are its aggregates. We have seen what is GDP at market price, we have seen GNP at market price, we have seen NDP at market price, we have seen NNP at market price, and finally we have seen what is NNP at factor cost. That's all for this video. We will again come with another video where we will discuss how to go for the computation with some numerical problems. That's all for today. Bye bye.